Hi, we're two gray beards. Our goal is to help you understand markets. And in order to do that, we need to look back to see where we have come from. And where we've come from is a long period of falling inflation, falling interest rates, and rising public debt. That has been a wonderful environment for all assets. And there's been essentially a 40-year bull market in assets. But that all changed. And that all changed when COVID created the conditions for a high amount of stimulus and inflation that followed. And that shift has put us where we are today. And over the last year, it has manifested itself with a significant increase in interest rates. Nick, what's your view?
I absolutely agree with you. I mean, the whole story of 2022 rather, is the return of the bond vigilantes. And it can be best described by looking at three simple charts that I can show you now. The first chart is a chart of TLT, which tries to mimic the long-term bond and its yield. When prices fall, yields soar. And as you can see, in 2021, we had a fall in TLT. And then in 2022, we had a collapse in its price from 150 all the way to below 100. That is a massive move. That is a massive tightening of monetary policy, and yields have gone from under 1% to over 4% in the space of 2 years. That has caused a massive hit on liquidity, and even more so if you have a look at what happened to the yield of the 1-year Treasury bill. It went from next to nothing, 5 basis points, all the way to 4.8%. The Fed is tightening and continues to tighten to bring down inflation, and at the moment there is no relief in sight. Finally, the third chart is a chart of the equities of the S&P 500 and their relationship to earnings expectations. All that happened in 2022 is that the multiple has come down as opposed to the earning expectations. As you can see, the earning expectations at the beginning of 2022 are very much the same, if not slightly higher than they are at the moment. So this move down in the equity price has been caused by a reduction in multiples, which is a direct result of the change in price of TLT. Equities relative to bonds have not done very much, and all the fall in price has been caused by the fall in the price of the bonds rather than earning expectations. The big question for 2023 is, are we going to get a recession with a corresponding fall in earnings expectations? Because if we do, equity prices are going to go much lower, probably to around the 3,000 level. And we just don't know that as yet. And we will know sometime, probably in Q1 or possibly Q2 of 2023. And then we will know how to best allocate our scarce capital. As a result of the massive tightening by the Fed and the move in long-term rates, we've had a violent sell-off in the equity market. Basically, all that's happened, though, is that we've had the multiples being contracted, i.e. the earning expectations
are very much still where they were at the beginning of 2022. The big question for 2023 is going to be, are earning expectations going to fall? Because if they do and the bond market does not rally, i.e. interest rates stay high, we're going to have another big leg down in equities. And that is a question for 2023, and where we think that we can help you step by step, week by week, to decide whether that is going to happen or not.
So, as Nick said, interest rates have risen. The Fed has engaged in a historic tightening by both raising short-term interest rates and unwinding their balance sheet in a process called quantitative tightening. That force has resulted in assets being less attractive to own. And so, as Nick mentioned, bond prices have fallen 35% on the long end. And short-term interest rates have risen by 400 basis points in a year. But at the same, so you had no place to hide in bonds. But at the same time, other assets like equities suffered because of this rise in interest rates. And any asset is just its future cash flows. And when interest rates rise, the value of those future cash flows falls. And so equities followed bonds down, actually outperforming bonds, principally due to the fact that the economy and the earnings expectations stayed robust. The economy is not in a recession. It hasn't gotten into a recession. Earnings expectations haven't fallen. And so when you add all those things up, asset prices in general, the 60-40 portfolio, for instance, has fallen 20% from across through 2022. And that is a significant drawdown. And as I mentioned earlier, it is an unusual event where both bonds and stocks fall. That hasn't happened in many, many decades, where you've had an extensive bond sell-off and an extensive equity sell-off. And that has created a problem for the traditional portfolio manager who stays in 60-40. So our goal is to explain how to better allocate a portfolio so that you can live through environments where there is rapidly rising interest rates. But here we are at the end of 2022, and the Fed has done a lot. As we've shown, they've raised interest rates a lot, they've reduced their balance sheet somewhat, and inflation seems to have, in the very short term, responded somewhat. And so it's unclear whether the Fed has done enough, but knowing whether they have done enough or not is going to be critical for asset allocation. If they've done enough, or if they've done too much, bonds will significantly outperform stocks, the economy will fall into a recession, and the Fed will ultimately have to ease. Now that's the regular last 40-year playbook. The other option is the Fed hasn't done enough, and they're going to have to be higher for longer to fight inflation. Though inflation has come down of late, it still is high, and given the tight labor supply situation, it could be the case that inflation stays sticky. In such environments, equities will actually do okay because earnings will still be fairly robust. But bonds will really suffer as inflation stays high, Fed rate cuts in the future become something that no one expects, and in fact, people begin to expect higher for longer. And right now, we're at the cusp of trying to understand which environment we're going to go into. it's possible that the Fed has engineered this perfectly, and inflation will come down and there won't be a recession. And that is what everyone calls a soft landing. And it's actually a fairly ideal time to own both stocks and bonds. Soft landings are wonderful things for the economy, for humanity, and for investing. But is that really likely? We think no, and we think we're going to go in one direction or the other. And navigating you through that period when we don't know, but we suspect it's not going to be soft, is going to be our value added.